Previously on the Real Forex Trader.
And yeah, I'm currently in a profit of 1.5%. This statistic is way too good. You can see there's a win rate of 85%. This risk reward is also very good. It's over 3, and that makes a profit factor of 18.
How? Hold on, bro. How? How you? I'm saying, how? Like, talk to me, bro. You the police? Is you the FBI? CIA?
Alright guys, welcome back to Yonayield. Hope you're doing great. Welcome back YouTube. This video guys will be very important because we will go into some deeper knowledge, and you know, I have been trading for 10 years, so I'm assuming this information will propulse you all the way to becoming profitable. I think this will be very valuable insight for you anyway. So without further ado, let's jump into it guys. Unfortunately, as you can see guys, I'm still unshaved.
You look like shit
At the moment, but I will take care of that. So basically guys, in my 10 years of experience with trading, I have noticed that the most difficult thing is to becoming consistent, and this video is all about how you can achieve consistency and become a profitable trader in the long term. So in my opinion, there are 2 holy grails, basically, if you can call them holy grail. I call them like that because everybody in trading is basically looking for the holy grail. And here is the big misconception guys. So everybody thinks the holy grail is some sort of strategy when it is not, right? There is no strategy that will make you profitable.
No strategy will make you profitable.
And especially no strategy that will make you consistently profitable. There is no such thing out there, and that's why you should not care about strategy too much, right? Strategy, in my opinion, is secondary. It's just a viewpoint.
The strategy is secondary.
As I have explained already, on filtering out nice points in the markets where you want to risk something, just to filter out these kind of price points, that is the strategy and nothing else, right? It's some kind of certain viewpoint, and each strategy has a little different kind of viewpoint. But other than that, it's not gonna help you at all in becoming profitable and consistent. So that is the big first misconception. The holy grail of trading is not a strategy at all. Okay guys, so then you might ask yourself, what is then the holy grail, right? What is the most important thing in trading?
Whoa. Here I come. Oh, here I come.
Is it experience? Is it risk management? Is it psychology? I would say all of these things are, of course, you know, important, and experience probably the most important one. However, when it comes to something that is going to help you to become consistent and profitable, there are 2 things in my opinion, or even 3 things that will help you like nothing else, and we will jump into them right now. So without further ado, I prepared a presentation just for you guys. Let's get it rolling. Let's go. See you on the other side. Alright guys, and here we are at the presentation overview.
Your life is about to change.
Presentation, this is still trading view.
You made over 3 minutes into the video.
Some stuff on the charts, especially.
I am proud of you, young Padawan.
Most easiest there. But now here is the presentation ready. As you can see, the title.
Never lose an account again.
Stop losing. The holy grail.
Become the best. Never full margin. Become the best.
So we want
Become the
to
best.
have a deeper look.
It's Yonayield. Let's go, bitch.
Smallest possible lot size activated.
Alright, so guys, the first holy grail here, you see it in this icon I've drawn up here, is the leverage.
First holy grail, controlling the leverage.
I have repeated this in all of my videos over and over again. If you can learn how to control the leverage, then you will never destroy a trading account anymore. So basically, let me tell you one thing. The two holy grails are basically set up in that way. Leverage is helping you with staying in the
EA Sports. It's in the game.
With staying in the game, therefore never losing an account anymore, help you with psychology, and therefore make you profitable in the long term, right? The second holy grail, however, is another thing we'll go in after that. And the second holy grail is all about consistency. Okay, so leverage is not about consistency, but it is still the most important thing, because without knowing how to control the leverage, you're basically done, right? So some people would say leverage would be a part of risk management. That would be true, and therefore risk management is the most important thing. I separate these things because they are just traders who basically believe, okay, I can have a tight stop loss of 5 pips, therefore I can have this very high leverage, and this is not going to work, right? So this is why I separate them, and I tell you, controlling the leverage, most important thing. This is the holy grail, how you will never destroy an account anymore, how you will get your psychology stable and stay in the game for the long term. Okay, so the first holy grail, learn how to control the leverage. So let's jump into it, guys. Know your instrument's volatility.
Know your instrument's volatility.
Okay, so now my question is, what kind of instruments are you guys trading, and do you know the volatility? Because that is the most important thing in trading, basically, because why you can make money in trading, why you can even do that, the only reason why you can do that is the volatility, right? This movement of going up and down, right? And that's what we call the volatility, and how much something moves up and down is the volatility, right? But the volatility at the same time is not only the profit, it's also the loss. So volatility means not only how much can we win, it also means how much can we lose. And therefore we need to know it for all of our instruments that we trade. So if you trade your instrument, my question for you right now is, do you know its volatility? If not, then you have failed already the most important thing about trading. Okay, so I personally trade Euro USD. We will take that as an example, but we will also look at some other instruments, of course. Now let's go into it. Now, how can we know the volatility? There are different things how you can know it. Of course, you can do even more complex stuff like looking at options, you know, stuff like that, implied volatility that comes out of the option prices. You can do that. However, there's a also very simple tool called the ATR.
Use the ATR to calculate your risk.
Probably you've heard about it, average true range, which basically goes back normally around 14 days, so 2 weeks, and it looks what was the volatility for the last 14 days if you look in a daily one, right? So this is the basic. Use ATR to calculate your risk. Okay, now let's look at the last point, then we will see it on the chart. Know your worst case scenario, but also know your targets. This ATR will help you to understand your worst case scenario, and also it will help you when to exit the markets, when to take your profits. Okay, so maybe that was a little bit abstract. That's why we will look into it now on the chart. And here we're already on trading view, as you guys can see. So guys, as you can see, I have opened here the Euro USD. This is basically the instrument that I am trading. And now this is the 1 hour chart. So we want to go on monthly. Okay, so let me show you my process basically. So this is the monthly chart. Let's ignore all of these silly drawings right here because they don't matter. Okay, so this is the monthly chart right here. So you can see each candle is 1 month. And now basically, if you don't understand the ATR, what it is doing, it's basically measuring every candle. So for example, let's look at the last month. So this is November. So this one was 500 pips in the range, going from the bottom to top. So it was 500 pips. Then we can go to the one before. That one was probably a little bit smaller. That was about 300 pips, let's say 300 pips. And then the one before was again like a momentum one. So that was, yeah, 400 pips. Okay, so and then it makes an average out of the last 14 candles, right? So the last 14 months. So if we look at this, we currently have an average true range in the Euro USD of 380 pips. Okay, that's what you can see in the figure right here on the monthly. So how do I use this to structure my risk? Basically, I don't do what everybody else is doing. Everybody else is just setting their stop loss at some level where they will get fished most likely and say, okay, I will lose 1% here, and this is how I control my risk. This is not how I do it. The first step, I do use an SL, but there's a one extra step before that. I look at the monthly ATR, weekly ATR, daily ATR, and so on. The monthly is basically the basis. So I will look at that. It's 380 pips. So I want to calculate my lot size in a way that I can sustain more than 380 pips, because this is the monthly range, right? So if I would get stuck in a trade or decide to maybe swing a trade a little bit, I need to be able to endure a monthly candle if it goes against me, right? So for me personally, I have my risk calculated in a way, this is also why it is like that in my FTMO challenge, where I can sustain 500 pips, right, in the worst case. Okay, so it's over this limit of 380. And now let's come back to this slide here before. Know your worst case scenario. I'm not saying it will come to that, but let's say I don't have a stop loss. Let's say my internet goes out. Let's say there's no way I can do anything on the chart. That would be hell. Every trader would be like going crazy psychologically. They would be, you know, be done. If that would happen to me, I would chill. I would probably go to sleep, don't even care about it, because my risk is calculated in a way that anyway I can endure a monthly candle. So I would not care at all, right? I have plenty of time to cut the trade at some other point. Okay, so basically this is the first thing that is very important. Look at ATR, and this is how I structure my risk. Okay, so I need to be able to endure one monthly candle, and as you guys know, I do trade on the 1 hour mostly. Now I will show you also how I can get my targets and stuff. But with that being said, if I will be day trading most of the time, what I am doing most of the time, my day trade, so I try to be in and out in the same day, because I don't like to be in the market, because the market is a dangerous place. So I try to be out of the trades if I can, always by the end of the day. So what do you think if I can sustain 500 pips until my maximum daily loss, for example, in the challenge is reached? What do you think is the probability that this will happen in one day? If I just don't put any stop loss and just leave the market and it can do whatever it wants. The probability of that is very, very low, right? It has to be some black swan event, it has to be some crazy news or something crazy that this happens. It probably most likely won't happen, right? There's maybe a 5% chance, let's put it down like that, that this will happen in this particular day where I have an open position at the moment, right? And that's why I'm super chilled, okay? And even if the trade goes against me, I don't care at all, right? This doesn't mean I will let it run there. This is not the idea. The idea is just that I'm, you know, always relaxed, stable, trade with small lot sizes, and I have no issues, not any psychological issues. And even if something happens, I know my worst case, it needs to go 500 pips against me, which it is hard to do for this kind of pair, as you have seen with the monthly volatility, right? With that being said, guys, let's look at some other things maybe, because you guys probably trade other pairs. So let's look at, for example, Nasdaq. Okay, what would I do if I would be in the Nasdaq? I would again go to the monthly. I would again look what is the average true range. So that is 1,300 points in Nasdaq. We can see the last monthly candle was again a rocket. It's an index. Index always goes up forever and ever and ever. But in 2024 there will be a crash, right? That's at least what I believe. But never short an index. I also talked about this in another video. Anyway, I will not talk about that right now. Basically, we can see the last month was a momentum one, 1,800, right? And so it was over the average, and yeah, so the average is 1,300. So minimum in my worst case in the Nasdaq should be that I can withhold 1,300 points, and that's how I will, you know, structure my risk accordingly. So if I in a challenge, I would probably look that this kind of 1,300 points is one time the maximum daily loss limit. If I trade a private account, then you can handle it more personally with what you're comfortable with. If your account is smaller, you can say, okay, the worst case is maybe 50% down on the account if that really happens, which is a lot. So if you have a bigger account, you want to have that tighter, say like, okay, in the worst case, 25% on the account will be this kind of big distance, etc., right? So as you can see, this is a whole different approach. I don't think about the profits first. I don't do that, because now you all say, oh, but then I can never earn anything with this kind of small, very small risk. And I say the profit is kind of a garbage on the side. I don't care about that right now. I just care about what I can lose, you know, and this is how it should be. You should not care about the profits or how much I can win if I make this big lot size there and there, and this is why I have to trade in that way. No way, guys. So Basically, this is how I would do it on the Nasdaq. Then you can also look for it in gold, right? So we are here at 116, I think in gold that is pips again, right? And etc., right? And so yeah, here in gold you can see it is around 116 or 117, and again you need to structure your risk accordingly. So now let's come to the next point, know your targets. So this depends on your time frame, right? So if I go back now to Euro USD, because this is what I mainly trade, so I try to catch, you know, one hour candle, maybe maximum 2 of them or something. So now I can look again, what does that mean? In average the Euro USD moves 17 pips, okay, that's the average. So that's why I know, okay, if I can catch in one day around 15 pips, I will be super happy, because that's kind of like the average that it moves in 1 hour. So my goal is 1 or 2 1-hour candles in one day, which would mean I would try to go somewhere between 15 and 30 pips. If it's sometimes less, 10 pips or something, of course I also take it, you know. But this is kind of how I know my targets. And if I see now a trade that is like going in my direction and I can see already, okay, we are over the average of 17 pips, we're already down 30 pips, then it's probably time to take it, because then with a new 1 hour it will probably turn around. Okay, so this is basically what I do in the daily basis. Seldomly I try to catch a trend. Normally I don't do that, but sometimes there are exceptions. I will show you why. This will come with the second kind of holy grail. Okay guys, so basically that much for the first holy grail, because I try to keep it short in this video. Okay guys, with that being said, we will now go to the second holy grail. Like I said, this is just a brief introduction to the concepts I use. We don't go too much in depth in this, because this is just a YouTube video and I need to keep it short, right? So let's keep it going.
Second Holy Grail. Dynamic risk to reward.
So now we are basically here on the second holy grail. Again, you can see this kind of nice floating holy grail in the sky. So because these two concepts for me are basically the things that come the closest to a so-called holy grail, if there is one in trading. Okay, so this one is called dynamic risk to reward. Okay, so it's about a dynamic risk to reward ratio, because this I think is another misconception a lot of traders do. And I also realized that because, you know, if I watch any videos on YouTube about trading and all of this stuff, I always hear like in a church, okay, you need to have a risk to reward 1 to 2, 1 to 3, you need to gain much more than you can lose, etc., right? And in my head I already think, okay, if everybody is saying that, I should do probably the opposite, right? So I can be profitable. And basically that's what I was thinking, you know. And then I realized with time, okay, it's actually about a dynamic risk to reward. And I will show you this now in more detail. As you can see, my approach here is again a little bit different from what is preached everywhere. If you compare this to the first holy grail, there everybody would preach about you need to have a tight stop loss, very tight, so you cannot lose anything with 1% only, and then you can use the high lot size. Like I said, when I hear this in the videos or see this, I already know I should do the opposite. So I do a very small lot size, not a high one, very small, and I give my trades a lot of room if they want to, because I know that I have calculated my risk in a way that not much can happen, and so I'm relaxed. Now back guys to this dynamic risk to reward, the second holy grail. So I basically look at both sides, right? What is the advantage of a kind of under one risk to reward, which you can see here, and what is the advantage of an over one risk to reward ratio? Okay, so let's jump into that. Let's look first on this side right here. So the under one advantages, right? I hope you guys can see this in the presentation. Yeah, it looks good. Okay, so basically here, if we go for a risk to reward under one and lower, what are the advantages? Basically we get automatically a high consistency. So this is actually something we like, right? Because think about it, if you have a risk to reward where you, I don't know, you can lose 10 times more than you can win, right? So basically what you're going for in the profit is only 1/10 of that what you lose. In that sense, you have small targets, you give the market room, and probably you should have like a 90% win rate in that scenario, right? And with that you achieve a high consistency. Of course, I'm not saying this is the holy grail, do that. Of course not, there's disadvantages, but just from looking at the advantage perspective, we will automatically get a high consistency, right? You have to be very bad to screw this kind of stuff up if you go with this kind of risk to reward, right? So we get a high consistency, which will help us to become a consistently profitable trader, of course. With that, automatically we have a high win rate. This is already given by this risk to reward ratio. I, guys, do believe that the markets are completely random. So that's why I'm saying it doesn't matter where you enter. If you have this kind of risk to reward, this is automatically what you get. High consistency, high win rate, right? With that, if you have high win rates and high consistency, you will have a growing EQ curve. So you will have a growing equity curve or growing balance curve, I should rather say. So basically it will trend upwards. It will always trend upwards, and that is a big factor for your psychology because it's easy for your psychology. You feel like a winner and you like that your account is going up, right? Of course, as you guys can already know, there's a big disadvantage coming, but I will talk about that later in the disadvantages. The last thing, it's repeatable. It's highly repeatable because you work with these small risk to rewards, so you should always win very fast and you can repeat the process. So that is also very nice. So now let's then look at the disadvantages, I guess, next. To not confuse you guys. So disadvantages here with the under one risk to reward. Only one big loss will screw up all of your gains, right? So that is the big disadvantages. So you can win the whole time, but if you lose one time, all of your gains will be gone. So you have this kind of EQ curve going up, 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 up. You've probably seen this in many EAs. They work like this. They always have this EQ curve going up, and then suddenly, boom, it crashes down with this one trade that just gets screwed up, right? So that is the disadvantages. If you lose, it will be a big loss, most likely. Then the other thing is a high win rate is required, you know, to be profitable, right? That is another disadvantage, of course. Okay, guys, then let's look now at the other thing. So other side of the table is over one risk to reward. So this is what everybody preaches everywhere. And let's look at the advantages. First of all, if you win big, so you have a big win, and that will make a big jump in your equity curve or balance curve, right? And because you have this one big win, you can be already profitable with small win rates. So it's not required that you have a super high win rate. You can have a win rate of 30 or 40%. You can still be profitable with this kind of system because you only need these few big wins and you could be profitable, right? So these are the advantages, okay? But now let's look at the disadvantages, because there are quite a few in my opinion, and so this is why I believe in dynamic stuff. And the disadvantages are you will automatically have a low win rate, right? It's very hard to get a high win rate with this. It most likely doesn't happen. You have a automatically low win rate, which means here this other disadvantage I wrote down here, you will have a falling EQ curve. It will always fall, right? So your EQ curve is always falling down, and that means it's very hard for psychology because you will feel like you're in a constant drawdown. Basically, if you have a high risk to reward like 3-to-1 or something, you will feel like you're in a constant drawdown. And now the last big advantage, you cannot miss the profitable trade. Okay, that sucks. Imagine you do this kind of system 3-to-1, then your EQ curve is falling down. Now for some reason you had to go somewhere, or for some reason you were not trading on that day, or you thought this opportunity was not good enough, but it was actually this kind of trade that would finally hit that 3-to-1 target and make up for all the losses. Well, if you missed that one, too bad. Then you have missed it, and then your EQ curve will go down more again with the next couple of trades because you just missed the profitable one, right? So that is another disadvantage, right? So as you can see, guys, this is just an overview. Probably there are more points to mention. This is just what I mentioned here. And yeah, now the big question is, so this is the holy grail. So we want to, the second holy grail. So we want to do now a dynamic risk to reward ratio. So what is the solution? Let's look into it, guys. So before we come to the solution, sorry guys, I'm teasing you here. Let me see. Yeah, we're recording, everything is good. So I want to show you this still graphically also, so you can imagine this better. I explained it to you guys, but let's look to it graphically. Okay, we talk about 10 trades now. Of course, we need to collect more data than that, but let's keep it simple at 10 trades. Okay, so how does it look now? We have 10 trades here, and we're now at break even, right? So let's say we have a low risk to reward. We have this kind of risk to reward where we win basically a tenth of what we can lose. Okay, so kind of like 10 to 1. So what will happen here? We will win, we will win, we will win, we feel great, our psychology is super, our EQ curve goes up and up and up, right? So imagine, I will draw this right here. In this kind of system, we will have this kind of equity curve, right? So it will always go up like this, and it's good for our psychology, and then this happens, right? Boom, yeah, not so much, but it will take us back again. Let me actually make this a little bit more clearer. So then it will come back to the even point, right? So this is basically what happens in this example. We go up, 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 up. Then here in the 9th trade, we had this loser, and even though the last one is a winner again, basically that brings us back to even, you know. So this is basically how it is with this kind of system. Now let's look at the high risk to reward. This is the other one. I don't have 10 trades here, so it you know, adds up mathematically. Otherwise I would have to put 12. Let's see how it looks here. So basically this is a 3 to 1. Okay, so the first 3 trades we lose. Okay, so how would this look? Okay, so let's compare. So this was the kind of low risk to reward stuff. Now let's look at the other one, right? So right off the bat we're just losing, and we just go down 3 times. So it's maybe like this something, right? And then after that we finally hit the winner, so it will come back up here to even, right? So you can see it is psychologically much harder because you are constant drawdown always, right? So now 2 things can happen. Either we hit another winner straight off the way, then we would be up here, but most likely because of the chances it will not happen, and we will have again some losers, right? So again we are going down. So how did I draw? Yeah, we have 3 back again, down, and then again this kind of stuff happened where we win. So we were constantly in a drawdown, and we need to have this one trade and leave that, you know, we need to be mentally strong to also leave that running to the profit target to just get back on the break even, right? So, and as you can see, in my opinion, this is not the best system. Even though everybody preaches it, it's very bad for psychology. And if you one time miss this one trade, what will happen? Well, basically then you will not come back here. Basically if you miss that one, you will continue to be in the drawdown and even go down more, right? So this is not good, you know. Maybe this one missing trade would have happened in the night, right? Maybe you were even sleeping, so you could not get the win trade. So this is not so nice. Okay, now let's look at the low risk to reward, because we have seen that we have a growing equity curve all the time. It makes us feel good, makes us feel profitable and consistent, but then this kind of trade happens. So how can we avoid this? Our mission, if we have this kind of system, is to cut out this kind of trade, right? And keep in mind, we only need to cut out one losing trade. Okay, if we can cut out this big losing trade, then this system is making us money, right? So how can we do that? Basically we need to know in the structure when it is a trend coming, right? Because basically in the normal sideways market we always win with this system, but if the trend is coming, then it will screw us. So with this system you need to know when you can let it run and when your kind of levels, technical levels, are broken, when a trend is forming, and then you need to cut immediately the trade out, because that one will probably be this one which will bring you all the way back, and then all your effort is for nothing, right? So but in my opinion it is easier to cut out this one trade that becomes a trend than to be in a constant losing row and then bank everything on the one profitable trade. And a lot of guys, this is why they always increase the lot size. What I should say, if you compare this, combine this with leverage, what will they do? In this high risk to reward setup, they will lose 2 or 3 times and they will not believe in the trading system, or they will get scared and they will increase the leverage, right? And now think about it, if the third one is not a winner, you know, it should be, because this is kind of 3 to 1, but let's say you have a losing row of 5 and you start increasing the leverage even, because you think now, oh, now the winner comes, now I double down. A lot of traders unfortunately do this because this attacks your psychology, this high risk to reward stuff, right? It's very bad for psychology. So then imagine on the 4th trade and 5th one they go with a higher leverage and lose even worse. in that case, what happens if you increase the leverage? Let me show you guys this. In that case, you will be in this kind of drawdown that becomes even more rapid, right? And what happens if you're down that much? 3-to-1 gain, if you finally get it, just gets you back halfway or something, right? So that means once you go down even steeper, you will want to increase the leverage more and more and more. So finally you get this winner that takes you all the way back somewhere in profit or on even. This is a terrible cycle to be in my opinion. This is why I'm saying no to that, right? So here, let's cross it out with a red one. Okay, so we don't want that. Yes. Okay, what about this one? This one is good, but it's not the best, as you guys can see, because one kind of trade will screw us up, right? So my question is, what can we do? How can we become better? And now we are at the final point here with this kind of risk to reward stuff. Solution is we need to combine both advantages from both worlds, so both systems. Okay, so what we want to do is combine this one with this one, right? So how do we do that? We saw what are the advantages, what are the disadvantages. How can we combine both systems or worlds, right? So we need to distinguish between sideways markets and trend markets for that, because we have seen with this kind of system, the one where we have a lot of small profits but we don't care about risk to rewards, we will grow steadily the account, but then when the trend against us comes and we don't go out, that will be the one big losing trade, which will screw us, right? We have seen that here, right? However, in the other system, this one, as we have seen, this one will always be losing in the sideways market, because we always hope, okay, the trend is coming, it will explode, we need to have 3-to-1, leave it, we will lose, because the market, 70% of time, the market doesn't do the trends, right? So we will lose here the whole time, and then we need to bank on the trend to get back, right? Which is very hard in the psychology, right? Let me take that away, because this system is not wrong. Both of them are good and bad, you know? So I don't discriminate against one of them. I want to use advantages of both of them. So this one is good in the trend, okay? This one is good in the sideways market. This one is good in the trend. So what does that mean? We need to know our instrument, you know, when is it trending and when it is not trending, right? 70% of time, the market is normally not trending. Overall, it depends on the instrument, right? But I'm just putting some figures here. And 30% of time it will trend, and we need to let it run. So 70% of times when it's not trending, we need to see that it's a sideways market, and it's just normal moving up and down that it always does in one day, and we take small profits always, and we don't care about risk to rewards, right? Of course, we do all of this with small leverage. This is the first holy grail, don't forget that. Then the second one is, okay, now we have a trend, it's a breakaway, it's a breakout. How you can find a trend and how you do that, how you know when a trend is coming, I will explain that to you guys, but not here. This will be in lessons that are more in depth, so I will show you this in like private lessons and stuff like that, but not on YouTube, because it goes too much into my system, right? I will not give away everything, of course. But now the thing is that we want to see when there is a trend, and when there is a trend, what we want to do, we want to let the runners trend, we want to let them run, right? But this only happens 30% of time, so we want to be switching from this strategy to that one, right? When there is a trend, right? So we need to be good in distinguishing between those two market situations, right? And as I said, how you can do this goes then into more technicals. I don't show this right here, unfortunately, but basically this is a lot of insight already, guys. So now another question is, okay, we talked about we want to work with this dynamic risk to reward, right? Another question is, how do we do this? Okay, how do you work with a dynamic risk to reward? Because we said we don't want to have a fixed system that always shoots for 3-to-1, because what happens in the sideways markets, we just pay all the time, and we need to be there for the trend markets, and if we miss it, then we lose even more, right? And vice versa with the other system, that we only take a little bit in the trend markets, we don't want to take the profit right away, we want to let it run. So how do we do that, right? It's not easy, right? Because But let me show you a little bit. So it depends basically on the account size and lot size that are you trading, right? That are traded, right? Because this makes a huge difference on how you use your dynamic risk to reward. Let me show you this. Basically, if you work with a small lot size and small account, in that case, you basically need to decide for each trade. Okay, is this just a sideways market trade? So I will take small profits and I will take risk to rewards under one. Okay, this is what I will do if I believe in a sideways market. If I believe it's a trend market, then I will try to go for a 3-to-1 or 2-to-1, whatever it is, and let that trade run. But I do this only 30% of time, right? So here I need to decide for each trade, and I have to have a good technique in place to read the markets, right? But I also need to know that most likely it will not trend. You know, 70% of time it doesn't trend anyway. But if your account is small and your lot size is small, unfortunately you have no other choice, but you have to decide it for each trade. So but now the biggest hack you can have in trading, and yeah, as a trader, this is the biggest hack, and I know some trader who's doing that. It's basically Roger Banks. If you guys have known him, I've watched his video. He's doing exactly this. This is basically the final part of the second holy grail, right? If you have a big account size and therefore you can trade a big lot size, it doesn't mean you want to trade a big lot size and have big risk, right? Because remember, first holy grail is you need to structure your risk, like as I have shown you with ATR. But if you have an account that is big, let's say you have a 1 million account, right? In that case, you can trade the big lot size without having a lot of risk on the table. In that case, what you can do is you don't need to decide anymore for each trade, is this gonna be a runner or not, right? Should I go for 3-to-1 risk to reward, or will I do sideways risk to reward, sideways market risk to reward that is under one? Here you don't need to decide because the lot size is so big, so you can live already from that if you just cut the lot size. So what you do in that case, why did I wrote 100% there? It should be written 90% here, guys. There's a mistake. In that case, when your trade goes into profit, okay, let's say you trade Euro USD, it's down 20 pips. So you know, in a normal sideways market, you know this from the 1 hour ATR, it's gonna turn around soon. So you know, in a normal sideways market, you would take a profit here. So, but now your size is so big that you can afford to say, okay, I just cut 70%, take a partial profit of 70% or 90%, somewhere in that area. So you should take more profit than not. Why is that? Because we know most of the time the market is anyway not trending. So we should always take more profit. So 50-50 in my opinion is not enough. So we should take 70, 80 or 90%. Roger Banks is exactly doing that. I've often seen this in his videos. He always takes like 90% or 80% off, right? Cut a portion. So because with 20 pips, let's say you work with a 10 lot size, right? If your lot size is 10 lots on Euro USD is big. If you have an account where you can do this without endangering the account and everything, without over leveraging, then yeah, of course, what would you do? You let it run 20 pips. Then you take your 8 lots out. You have a nice profit, you know, 8 lots, 20 pips. That's a huge profit. I will not calculate it right now, but that's a lot. And after that, you still have 2 lots running, and 2 lots, as you know, is also not bad, right? Imagine that trade goes now 100 pips in your direction. How much is 100 pips with 2 lots? It's $2,000, guys. So with that being said, once your account is so big, then you don't need to decide anymore which way of the risk of the dynamic risk to reward should I use, should I go. You always can cut. Of course, oh, now I know why I wrote 100%. Of course, you can also decide to cut everything if you don't believe in a trend at all. Of course, you can cut also 100%, but normally you should always give a rest probability. If you don't believe in it, you make a 90% cut. If you believe more in a trend, then you do a 70% cut. If you believe strongly in a trend, maybe do a 60% cut, right? Something like that. And as I said, guys, if it then drops 100 pips straight in one move down, that can happen in a trend, right? Then with 2 lots, you make $2,000. With 3 lots remaining, you make $3K. okay? And this is basically the biggest hack, right? So, and for that, unfortunately, you need to have a big account size, right? But once you have that, then you should do it that way. As long as you don't have that, as you work with the small account size and small lots, then unfortunately you need to decide, all right? If you want to bank on a trend trade or not. But keep in mind, 70% of times you should take the profits anyway, because the markets most of the time is not trending. Okay guys, so with that being said, we have looked at the 2 holy grails, guys, and I hope that really helped you and you could take a lot away from that. This is like one of the, in my opinion, best knowledge that you can get. I give it for you. I give that to you guys so you can be on a good path in your trading career. And yeah guys, I've been doing this for 10 years, so I know all of the statistics and how this stuff works. So basically guys, now I have one more bonus thing.
Bonus round unlocked.
So guys, this basically is a bonus holy grail, right? I don't say there are 3 holy grails because this 3rd one is not so good. It's a dangerous one as well, so you need to be very careful about this one, but it is, in my opinion, also a big advantage if you know how to use it and if you use it with discipline, right? So this one you need to be very strict on, right? It should not be a way how you kind of manipulate yourself or how you kind of lie to yourself. That it should not be, right? So this one is price averaging, right? And by no means I mean martingale, that you should never do, but I mean normal price averaging in the sense of dollar cost averaging, right? So what do we do here, okay? So first of all, the premise is that markets go up and down randomly and you will never get the best point. That's how it is, you know? Doesn't matter how good your strategy is, in my opinion, it's a random going up and down, and there's some points of interest where you try to do something, and other than that, it's anyway random, just leave it. But most of the time, you will anyway never get the best point, and that's why you should have, in my opinion, some kind of price averaging built in your system. How do I do that? I only average if I don't have a good price one more time, right? Again, I look at ATR, what makes sense. I look in the 1 hour, right? And if the trade basically goes against me 30 pips, 40 pips, 50 pips, if I would be still in that trade at that point in time, I need to decide if I would want to do that or cut it, because it can be that trend trade against me, right? Like I said, and I need to cut that out. But let's say I believe in a setup, no technical structure is broken, then I can do an average, right? Because if it has gone against me that much, and you need to leave it some room, you cannot average in after 10 pips, that's not enough. Look in the ATR, you know, you want to average in maybe after 2 1 hour candles have gone against you, which in that case would be 40 pips, right? 40, 50, maybe 60 pips. Then you can decide to place one strategic average, right, with the same size or lower size, right? Never a higher size, and only one time you do this, because you don't want to be stuck in the trade and just keep putting in more risk. You don't want to do that. The risk needs to be controlled. All right, so I do strategical averaging one time. Normally I go with a smaller size, so let's say I opened a trade with 2 lots, then I put in an average with 1 lot, right? Because you can do it like that, or you do the same size, then you get the exact average price in the middle. But normally for me, I want to be secure, so I go a little bit smaller. Okay, so this is the solution is averaging, like I said, for this kind of market behavior where you never get the best point. And you can do this, you need to see how you structure your system by yourself, right? I'm not gonna help you with that, but in my case it is, I can do this one time, but no more. And if it keeps going against me after that, I need to cut the trade, right? So basically solution is averaging, but big exclamation point right here, but you cannot over leverage, right? Because a lot of traders, they do this averaging, which is very advantageous, but then suddenly they kind of fell in love with their trade, or they use too much leverage in the beginning, and that's why they become all crazy and stay in the trade. So you should never do that, like a deer in the headlights, right? You don't want to do that. Already your first position must be so low leverage that you can afford the second average, right? It needs to be low leverage from the beginning, then you can afford the second one. If your size is big in the beginning, you should never do anyway. Remember the first holy grail, but it is, then you cannot afford an average anyway. So don't even think about it. But if you're small, then you can afford a second average in, and then most of the time the market will turn around because most of the time it doesn't trend, right? However, if it starts trending, then you need to cut the trade, because then it will be that one trade that will screw up the whole equity curve, right? As I showed you, if you have normally risk to rewards under 1. Okay. So yeah, guys, that is basically it. And let's go back here to the presentation, back to the overview. So hope it was clear. You basically want to take the best out of both worlds, both ideas. If you are really good, then you will have crazy good statistics, because you will manage to profit in the sideways markets with the risk to rewards under 1. But then you have these exceptional trades where you know it's trending. If you leave it there, then you will have these runners where suddenly your risk to reward ratio will be increased by a nice outlier, right, in the data, because you let it run. And if you become really good, then you know then you have a system where you know when it's trending and where and when it's not, which is the most difficult thing to do in the market, also to distinguish between those two. But I have also some strategies how you do that, but unfortunately not going to go into that now. With that being said, guys, let's jump into quickly my FTMO statistics also, so just that you know what's possible here. I've showed you this in other videos already, but quickly update you on here. Basically, that's how it looks here in the client area. And with this kind of system I showed you, these are kind of the stats that you can get with it. Okay, you can be highly consistent. As you can see, every day is a consistent gain. I keep the losses small, right? And you can see I have a high profit factor of 5. It has been even higher. It was at 18 in the beginning, which was absolutely crazy, but of course it will not stay like this. And you will have a good win rate, right? So all of that is good. One thing is that today I missed a big chance to have that runner. Unfortunately, my profit factor could have increased today a lot, because I could have gotten the average profit up a lot. Today I could have easily made a $400 profit day. Let me show you guys this in the chart quickly, because I made a technical mistake today, unfortunately. All right, guys, so let's look into this right now. So this is the FTMO challenge account right here. And let's look at EURUSD right here. So unfortunately today I was pretty much sure there should be a trend day here, and also if you look in the structure, I was pretty convinced that it will take out minimum this low point or even this one down here. If you look, let's look in 4 hour maybe, it was pretty clear to me to go to these low points here. And the problem is why I didn't let it run, and this was a really stupid decision. I had a couple of shorts here, so this was the first one. This one I didn't let it run because I was thinking it would come up again, which it did, so that one was okay. Let me guys show you this maybe a little bit more here in the 30 minutes is maybe pretty good to see. So basically, yeah, so here I was in too early, so I went back in here and had a nice profit here, which was okay. So then this one I'm not happy about. This one was a very good entry, and I should have let this run, of course, somewhere down here, and the best would have been down here. You don't get the exact low point, but I would have been pretty happy with the price here at these levels, which also would have been this kind of low point, which I showed you in the bigger structure. So I should have let this sell run until this low point, you know, so until right here, you know, there I should have cut it. Now the only reason why I didn't let this run, and this is a very stupid reason, I was under the impression that today is non-farm payrolls. So first of all, I didn't even want to open that trade really, because I was scared, okay, non-farm payrolls is coming. But I looked at my watch, I was like, okay, there's still like 2 hours to go, so I will open this trade, but I will not stay long. So right away this trade went down pretty quickly, so I was like, okay, just cut it, because I don't want to be there for NFP. And then now tonight I looked at the calendar, the news calendar, and there is no NFP today. I was like, I should have looked in the news calendar, so big mistake on my side. I was just assuming 1st of December, new month, it's Friday, must be NFP day. Normally it is, but it's not. So I went out unnecessarily because I don't want to be involved in news at all. It's way too dangerous. And yeah, if I would have known that there's no NFP, I would have let this run, you know, minimum until down here somewhere and then cut it. So this could have, you know, be very good for my stats, because this is kind of the runner that I need, where I need to switch from intraday, take small profits, to this one time where it then starts running, right? And yeah, unfortunately messed up on that today out of some very silly reason, but that's basically what it is. Okay guys, so basically this is how it looks here in the challenge. I take it very slow. You can see how small the lot size is, how small the leverage is right here. I only take like 1 lot, 1.5 lots. I have now 50 trades in already, so it's a good data set. So you can see the data is still very good, all of these statistics. Of course, profit factor and average profit could have been much higher now today, but screwed up on that a little bit. Then you can see I'm up now 2.3%, so I take it very slowly. Have been trading for 10 trading days, and my goal is just to grind slowly to this profit target eventually, but I don't even care when I will get there. Just slow grinding is my target here, so I can be safe with very small leverage, right? And as you can see guys, all of these things I explained to you today, keeping your leverage low, your lot size low, dynamic risk reward, all of this stuff is 10,000 times more useful and important than strategy, right? So this is one final key point I want to tell you. Stop focusing on strategy or technicals, or like I need to find the perfect trading system. It doesn't matter, right? It doesn't matter. I have found out these things are much more important, more useful. You need to control your psychology with the leverage that is down. Once you have this in place, then you're on a very good path, and strategy, technicals, this is secondary. It doesn't even matter. You could probably even just trade randomly almost if you keep these kind of things in place that I told you about today, right? And even probably build a good equity curve still. That's basically how unimportant technicals are, right? And strategy. Okay guys, with that being said, I will interrupt the video here. I think it's too long already, and I wish you a wonderful weekend. Take care. Catch you in the next one. Peace. One last thing I should also mention, you know, about these kind of two systems, right? The one system with the low risk to reward and the one with the high risk to reward is basically, they're almost like two different creatures, right? Like imagine you're a Pokemon trainer. Example, but imagine you're a coach, right? Then you also need to know at what situation what card you play, right? This is why I'm saying not one of them is bad and one of them is good, right? That's not what I'm saying. So maybe it was kind of like coming over in a way that I was discriminating against this kind of system a lot. I just did that because everybody is preaching this kind of high risk to reward, when in fact this one is harder for the psychology, right? This one is harder. And the other fact is, market is trending only 30% of times, so only 30% of times you should use this one, 70% of times you should use this one, and nobody cares about this one for some reason. Everybody wants only this one and show you the crazy big RR trades. I did a 10-to-1 risk to reward, oh yeah. So I don't mean to discriminate against any of them. For me, they're just two different creatures, and like you're a Pokemon like coach, trainer or whatever, you need to know in what situation you will play what creature, right? That's basically what it comes down to, and this is why you need to exactly know what are the advantages of this creature and what are the advantage of that creature, right? So like I said, this creature is super in the trend market here, and while this creature is super in the sideways markets. So this is how I need to know when to play which one, right? So it's kind of like I have this set of cards. When will I play what card? Which card is good in what situation, right? It's like in the Pokemon, like when do I play a fire Pokemon? When do I play the plant Pokemon? When do I play the water one, right? It's basically like that, okay? And once you have a lot of market knowledge, a lot of observation of the markets, then you know when this market will go in trend and when not, especially if you trade the same pair over and over again, the same instrument, right? So another tip, focus on 1 or 2 instruments so you can get a good feeling for them. Okay guys, and that's basically it.